This content is general in nature and should not be considered financial advice. Please listen to the full disclaimer at the end of our podcast. All right. Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today, we have one of our favourite guests coming on again for another Property and Finance podcast. We have Nicola Powell, the Chief of Research and Economics at Domain. Nicola, welcome back.
Thanks for having me. This is my favourite time of the year because it does mean that it's nearly the holiday season. So it's always a great time to look back at what we predicted and look forward to what we expect for next year.
Yeah, Nicola and I were just talking offline about how it's a great time of year for us to have our annual session that we do. And it's right in time for Domain's annual report that comes out. I think it came out on the 4th of December, was it? About a week ago.
Yeah.
Or maybe a couple of weeks ago by the time some of these listeners jump online to our podcast. And that sort of reflects the year that was, and we have a look at the year ahead. And we were both just joking offline before this session that, we like to somewhat keep our guest speakers accountable to what they say or forecast. And my gosh, did Nicola and Domain hit the nail on the head with their forecasts in the past?
Yeah, I was, I was looking at the notes that the PR team threw in, and I was like, thank goodness that Theo is holding me and my team accountable for our forecasts, right? It's really hard to forecast where the property market is going to go, particularly if you're looking 12 months or more, because there's so many things that factor into a forecast, and there's so many things that can change in the economy that can change the outlook. But I did look back at what our forecasts were for the entire calendar year of 2025, and I am quite pleased that we were pretty much on the money across many capital cities.
Yeah, definitely. And I think before we dive into those forecasts and I guess the historical and then look at the forecasts ahead, that's the beauty of these sessions with you and the information that you can share is that you have such an abundance of data at your fingertips. There's very few guests that we get onto our podcast that have such in-depth, broad data across all markets of Australia, which you can then analyse with the resources of Domain. You can analyse and put such accurate forecasts together. So it's very interesting. Is it evolving? Yeah. Those forecasts, are they evolving much in the way you analyse data?
Absolutely. So, we have relooked at what our forecast model is. And I think one of the aspects of our forecast model that differentiates ourselves from other forecasts that are out there is that we use our rich behavioural data. And almost behavioural data is an aspect that is a forward-looking indicator, because we know that when people are coming onto Domain, they're on a journey, right? And you start looking for your dream home well before you're purchasing. So it's a really good metric that we add into our forecast. And even when you look at the balance of views per listing, that can also give you an indication of where the market is going. And what we probably get into this a bit later, but the end of year wrap is probably my favourite report of the year, because it really holistically looks at what did we see and what were some of those behavioural changes. And one of the powerful tools that we have is looking at what's called keywords. So this is what I describe as someone who's really high intent. They're coming onto Domain and they're using a specific word, whether it's pool or whether it's granny flat. And this was one of the things of 2025 is we saw anything to do with affordability rise through the ranks. So it was dual, it was duplex, it was granny flat. So there's some really interesting shifts occurring in what people want from a home.
That is so interesting. I don't know if we actually spoke about in previous sessions that type of keyword data. I think maybe lightly or briefly, but typically that's not the type of data that a real estate agent would capture. It's something that Domain and the other competitor, I have to say, REA, is capturing when people do those filters and searches and highlight sort of what they're looking for by clicking pool or parking. Or I did have a look at did read the report, and it is interesting how in different capital cities, the different aspirations that are coming to fruition of buyers, I guess, interests or desires. That's definitely quite unique. So we'll go into that, but let's start with the year that was and your amazing forecast this time last year and how you nailed it. So the one thing that we didn't quite get, but no one quite got, was the interest rate forecast. We were close, actually. We were saying April will be the first rate cut. I think we both said about April, May. You said April, maybe I said May, and it was February. I think we were both thereabouts close on the amount of cuts, 3 to 4. Everyone was anticipating that fourth cut this month, but that didn't happen. That's obviously amid rising inflation concern. So new data promotes new forecasts. We can't hold ourselves too harsh on that. But the more interesting one, and the harder thing, I think, to forecast is what you nailed, being which cities will be the top performing cities in Australia. And you rightly called out Adelaide, Perth, and Brisbane, which were the highest growing cities this year in 2025, based on that end of year RAP report that came out this month, which they all showed 9% in houses, which is the highest annual percentage for any capital city in Australia. And then in the units, they were much higher, between 12 to 16% growth in those three cities as well, which is almost 2 to 3 times more than Sydney and Melbourne. I think we saw that units, the pace of growth doubled the previous year. And that's because houses have performed more in the previous years. That was, I think I saw in that report, we saw like 50% increase in house prices combined across capital cities since 2019.
Yeah. And I think when I look back at those forecasts, we were, as you rightly said, bang on the money in terms of the cities that were leading the pace of growth. I think the thing that perhaps we weren't bullish enough on was the performance of the unit sector in Brisbane, Perth and Adelaide. And I do wonder whether, our prediction of when we were expecting rate cuts to occur actually came much sooner than we anticipated, which can influence the market. So I do that perhaps the earlier rate cut, that one that was delivered in February, I think we were seeing investors as that buyer segment really coming out and purchasing. When you look at the growth of investor lending, there were 2 back-to-back quarters where the growth in investor lending grew by about 20%. And as a share of overall lending today, it's around just over 40% of overall new housing finance, which is large. And a lot of that is going into the established market. About 4 in 5 investors are actually buying established homes. But I think what we saw was an interesting reaction from investors. They reacted to the rate cuts and they came into markets that were seeing strong rates of growth, and they prefer units. So I do think a lot of that growth in Brisbane, Perth and Adelaide in the unit sector was coming from investors, but also changes in affordability. So the inability of first home buyers to purchase a house and actually steering towards units. So, in hindsight, when I look back, we should have been a bit more bullish in that unit sector.
I'm glad you called out that 20% increase in investor activity, because that is interesting. And yeah, there's definitely also been a bit of a shift in investor, I guess, attitudes and type of investments as well. We saw the rent vesting strategy continue on from the year prior. The whole sort of first home buyer market getting priced out of buying homes in the areas they want to live, and instead turning to buying investments in other marketplaces, which probably touched on some of those the changing purchasing trends. So I also read in your report a bit of a shift towards the sort of dual occupancy houses or duplexes, shared living, granny flats, both as owner-occupied purchases and investments, right?
Yeah, absolutely. And I do think that this is one of the shifts that we're seeing across Australia, and particularly so in our most expensive capital cities, which is Sydney, is this concept of multi-generational living. Many families have got children staying into their, adult years, because it is so expensive to either move out to go to university or just to buy your first home. So I actually think this is the reality, right, of having such an expensive capital city as Sydney. When you've got that median house price sitting at around 1.7 million, and we've got our forecast predicting that the median house price in Sydney is going to hit 2 million by 2027. That's a very realistic forecast that we've got for Sydney house prices. And I think what's interesting in Sydney is granny flat was the second most searched keyword, and pool was number 1. But normally pool is number 1, right? Australians are lifestyle driven. Pool view is always a priority. But the thing with Granny Flat, it's seen such an increase in the number of searches that it's almost overtaking Pool. And I don't think I had ever anticipated seeing that. And I actually think that really demonstrates a fundamental shift, not only on what we want from our homes, how we're using them as well.
So that's really interesting. Let's just call that out in a bit more detail, in the sense that people are searching granny flat, meaning that, they're not trying to buy a property and add a granny flat. They're buying properties that already have a granny flat on the property, because we see in our world of finance, with investors looking for investment opportunities, or even mums and dads looking to earn additional income, we see a lot of people adding the granny flat. But you're saying that actually now there's a big shift toward people just looking to purchase a property that has that existing, because some would assume in the past that limits a property's appeal, but it's quite the contrary.
I think it is quite the opposite. And I actually even think that changes our outlook on supply, from a development perspective, or as a homeowner, the additions that you could add to your home to actually add value and add that attractiveness. Granny flats definitely have seen a continued rise in searching. And I think it's multi-generational living. It could be the fact that people want the ability to perhaps rent something out, that secondary income, or it's work from home, that space, dedicated space to have a business from home or working from home. So I think we're definitely seeing a change unravel, and 2025 has actually been quite powerful in that kind of affordability angle of granny flat, dual, duplex, that type of configuration.
And that probably goes to, it's a good segue to the population growth. We saw steady population growth, and if there's a lot of migration, perhaps, there's international house guests coming to stay in that granny flat or whatnot, because we saw, I think, 3.2 new people for every new home built in recent years. So the population growth is still steady and strong.
The population growth is still strong. And I think that when you compare population growth, though, to that kind of post-COVID migration, we've seen it ease, but it still is high. And ultimately, we're still not building enough homes to meet population growth. So we have an undersupply of housing that continues to build up, and that is something that has been building up for many, many years. And it's not something that we have solved yet. And I think this is one of the reasons why we continue to see property prices rise. There is still lots of competition. There is particularly lots of competition for affordable homes. We had a look at price segments. So this is the different priced properties within a city. So we call them entry level and the upper end of the market. And what we have seen over the past 5 years is entry level house prices have outperformed the upper end of the market. That is another theme that really kind of feeds into this affordability dimension that is Australia, in terms of how challenging it is to find an affordable home, particularly in a market like, you bring up Sydney, but particularly in a market like Sydney.
So that probably makes me want to go back to affordability restraints and, I guess, stretch budgets on how much some of those prices have increased. So I think we saw that in Brisbane, which was naturally a city that people used to migrate interstate to for affordability reasons, right? Now Brisbane's become the nation's second most expensive city, I believe. And Adelaide also, once a more affordable city, it's the third most expensive unit market, surpassing Canberra and Perth.
It's quite phenomenal. I think when you look at 2025, it's been the change in Australia's market hierarchy. We saw Adelaide join the $1 million median house price, and obviously Sydney, Melbourne, Brisbane and Canberra are already there. We're expecting Perth. It's on the cusp of being a $1 million house price as well. So, by the end of the year, we are going to see the majority of our major capital cities having a $1 million median house price. And so you have to think that we used to describe Perth, Adelaide, and somewhat Brisbane, our more affordable capital cities. And I think that is very challenged when you've got a median house price above $1 million. And as you mentioned, Brisbane has become the second most expensive capital city, not only for house prices, but also for units. And the change in affordability in Adelaide has been nothing short of remarkable. This is a market that has continued to grow. It didn't see any pullback in price when we saw that unravel across some of our other capital cities. And Adelaide has always been described as that, I describe it as that quiet achiever. And that cannot be described. That market can't be described as that over the last 5 years. It's been unstoppable. We've seen double-digit growth for many years in the market of Adelaide.
Very interesting. So I guess another thing tying into affordability constraints is obviously firmer lending conditions. Now, when I say firmer, there was still obviously higher rates the year prior, but the 3 rate cuts didn't quite equate, the 3 interest rate cuts that we saw in 2025 didn't quite equate to what buyers were expecting for a boost in borrowing capacity. It was only roughly about a 7% increase, those 3 rate cuts. And that's because banks had to update their minimum living expenses, the HEM sort of regulated expenses used in affordability assessments or credit assessments. And that's because naturally with inflation, we've seen such a increase in essential expenses, things that are not discretionary. The biggest one we saw in the October inflation data was electricity. Electricity was up 9% for the quarter, I believe, and something like 23% year on year. Now that's something that you can't decrease your spending on that easily. And it's funny how the RBA has a monetary policy around manipulating inflation when there's things like that are outside of the RBA's control. But yeah, that's definitely put pressure on households so that, even with 3 rate cuts, it's not like people can go borrow a lot more money. And even with 3 rate cuts for existing homeowners, they probably didn't get the relief that they were hoping for with the overall increase in housing in terms of expenses.
Yeah. I do think, though, that rate cuts, what they create is a behavioural change. It's like a mindset change. And this is the aspects that I really love about housing is this kind of emotional kind of behavioural side. And I think that when we saw that rate cut being delivered in February, I spent a lot of time thinking about this year and how it unravelled in the housing market. And I feel that in February, when we saw the RBA deliver that rate cut, it was, a little bit of steam being released from the pressure cooker. It was this kind of mindset shift that we are now going to see rate cuts come through. And I felt that Australia almost breathed a sigh of relief, particularly mortgage holders at that period of time. And what we saw this year is a cautious approach, I would describe it, from the RBA. They were slow and steady. I mean, this rate reducing cycle was like one that we'd never seen before. It wasn't back-to-back reductions. They were spaced out. It was February, March, April, it was May, and then it was August. So they were spaced out basically once every quarter. And so you didn't have this mass amount of energy being piped into the housing market because it was slow and cautious approach from the RBA. But as you said, the borrowing capacity for your average Australian dual income household was about an uplift of $74,000. But, inflation, cost of living, it's still so much higher than what it was. And we can thank the electricity rebates rolling off, really kind of boosting the cost of electricity. And I do wonder whether we'll actually see some more rebates coming through because I think it is such a pain point for households. But I describe it, Theo, as the paradox of 2025, right? You've seen borrowing capacities increase by roughly 74,000. But on the flip side, the performance of our housing market across most of our capital cities has outperformed that borrowing power. So, it's almost like the rise in property prices has eroded the benefit of that additional borrowing power anyway.
Yeah, that's for sure. That message is loud and clear, and some people are definitely feeling that. So just to go back to a couple comments there. So the sentiment from interest rate relief, right? That's something that we've spoken about in our podcast for years. I feel like the power of sentiment and consumer confidence has never been greater in effect of what it does to the front line of buyers and vendors in property transactions and prices, right? The FOMO, the fear of missing out, really kicked in from February onwards as soon as we had that long anticipated first rate cut. And then, yeah, you're right. They were sort of stretched throughout the year. The RBA was cautious on, slashing rates in a hurry and wanted to keep watching ongoing inflation data, which most recently became alarming, and that forecast changed overnight, which then directly correlated to a change in sentiment and confidence that we saw on our end. So with the buyers on the front line looking to purchase property, as soon as that October data, the 28th of October, I think it was when it came out, the quarterly inflation data came out, which was a lot hotter or higher than anticipated. We saw a significant increase in the year on year and sort of quarter on quarter inflation data. Even though the economists were forecasting an increase, that increase was much higher than they were forecasting. And then the monthly indicator subsequent to that in November is sending the same signal. So now all of a sudden, buyers have gone from expecting maybe a fourth rate cut in December or February to potentially a rate rise in February, which is all going to be, off the back of whatever inflation data comes out in January, at the end of Jan for the quarter. So that's an interesting new shift in landscape. Buyers have gone from pricing in more rate cuts to now maybe having to factor in a rate rise in the near future. We saw the money markets also immediately change their forecasts to potentially have a rate increase in 2026. So, how's that look on your world of sort of consumer reactions?
Look, I think it really brings home the message. It's a timely reminder that the narrative can shift very rapidly. And I think that that's what we were all probably side-swiped by over the last few weeks, is just how that reacceleration or stubborn inflation, I would call it, has changed the outlook for the cash rate. And I think that, it is a confusing message for your everyday Australian. And I think it also brings it back to, we could get one or two data points that are weak that could also shift the outlook. When I think about, we track the market implied yield curve, and for anybody that doesn't understand that is basically the market pricing in where they think rates are going to go. We track that at points in time, snapshots, and honestly, it's like a rainbow. It's very hard to predict where the cash rate is going to go, and it really does bring home that message that a couple of data points can shift that narrative, and that's exactly what we've seen. But I think, it does influence sentiment, and there is a big correlation between consumer sentiment and transactional activity in the housing market. And I track the Westpac Melbourne Institute consumer sentiment, and their November index was actually into positive. Now, a reminder that we have been a nation of negative Nancys for quite a few years. So this was the first positive read on that sentiment since early 2022. So it's actually a 7-year high for the index if you exclude that COVID period, which was very volatile. So overall consumer sentiment has been rising. What I'm going to be interested to see is how do consumers react to some of those November reads on inflation, the stubborn inflation, and what we might see with consumer sentiment, it lags a little bit in terms of it is a bit more it will be volatile in reaction to the inflation. But the point I'm trying to make is consumer sentiment is very important for housing markets. And when you see consumer sentiment rising and nudging in positive, it tends to play out positively well for housing transactions and price growth. But I think what we're likely to see is the recovery in consumer sentiment has been uneven, and that is because inflation recovery has also been uneven. So I think the outlook is still going to be a little bit rocky, but I think how consumers are reacting means that I just think we're being a bit more cautious on how much debt we take on and what we actually purchase. And, I think that's probably a good thing. I think there are two really strong messages there to ensure that you're purchasing the right home and you're not taking on too much debt.
But I think the call out there is definitely along the lines of how reactive consumers are to those data sort of points or new pieces of information that come out. It's crazy how reactive we are in a modern world with information at our fingertips. But yeah, look at it's definitely going to speaking about that yield curve that is forecasting the where rates are going to be. I think the latest time I looked at it, which was probably last week, we saw it's pricing in an increase at the end of 2026, right?
Yeah, I think I'm opening it now actually as we're talking to see it change.
Just a 0.25, but just like you said, I liked your analogy that it's like a rainbow and it changes all
Yeah.
over the place. And, a lot of people do think if you chase it to the bottom, you might find a pot of gold. But,
Well, we all hope that, right?
yeah.
I mean, I'm looking at the implied yield curve at the moment. There's a probability of a 30% likelihood of an increase at the next board meeting. And look, that does change. I mean, on the 26th of November, there was no probability of a rate increase at the next RBA board meeting, and now it's sitting at almost 30%.
And
but as you and I know, it changes regularly.
yeah, I think a couple months ago, early October, before that inflation data came out, they were pricing in like a 70% chance of a rate cut yesterday in early December. So yeah, it's up. That forecast is up and down like a yo-yo. You can't sort of bet your bottom dollar on it. That's for sure.
Yeah, I'm not convinced. Look, I'll stick my neck out. I don't think we're going to see a rate hike in February. When you look at the yield curve, we could see one, say, mid next year. I think February is just too early. Look, and the one shift that we have seen is Australia, the Australian Bureau of Statistics is now producing inflation on a monthly basis. So what that means is before it was quarterly, it means that we've got more timely, or the RBA have more timely information. They used to have a monthly index, but it was only a partial read. So they were only getting a snapshot of the CPI basket, whereas now they're producing a full CPI read on a monthly basis. This puts us in line with global peers, and it gives the RBA far deeper information and more timely information to make better judgments.
Wow, that's very interesting, actually, Nicola. You're the first person that's called it out, because we've had all forms of fancy chief economists and research analysts talking about how the quarterly data is the only one to rest your hat on. Even I was at a work function with Matt Common a couple of weeks ago, who was saying that the quarterly print is the one that we've got to keep our eyes on. So that's news to me that the ABS is now going a bit more in detail on that monthly indicator, because I always thought the monthly indicator was simply that, an indicator.
Look, it used to be what's described as a partial read, so it wasn't, a full read of what is the CPI, and they changed that. Their first full read on a monthly basis was in November, so it's been a very new change. I think, though, it's going to take some time because you can't seasonally adjust it. You need a bit of a time series, so I think there's going to be some time that needs to lapse. But yeah, November was the first time that we'd seen the ABS actually produce that full read of the CPR basket.
Interesting. All right. We'll have a deeper look into that one. Let's talk about more of this data and information you have at your fingertips, and what else 2025 showed. I might be putting you on the spot here, but luckily you're in front of a screen. We could probably bring up some information, but auction levels, stock levels, clearance rates, all the general high-level data that real estate agents and news reporters rest their hat upon. How did that shape up this year? I think we saw, my understanding was definitely some increased sales volumes, but at periods it was met with higher clearance rates, right?
Oh, definitely. I think the clearance rates have been a very interesting markets to watch. And we know that Sydney, Melbourne, and actually Canberra as well are our bigger auction markets. The other capital cities are less auction-led. And I think when you look at the time series over every single month this year, we definitely saw a strong period for the auction market in the winter months and that very early spring period. I think what we've definitely seen over the recent month, which was obviously November, which is just closed, we saw Sydney and Melbourne clearance rates at 63%. That is slightly lower than what we were seeing in August and September, where we were seeing clearance rates at around 70%. The best way to explain the drop in clearance rate is really higher levels of volumes. We saw significant volumes of auctions occurring in Sydney and Melbourne, like the highest levels we've seen all year and for a number of years in those two markets. So I think what that does is when you see a boost in auction volume, it tests buyer depth, and obviously it gives buyers more choice. So it has helped to ease that clearance rate. But what I would say, clearance rates are a really good indicator of market health. They're timely, they're produced on a weekly basis, and analysis shows that 60% is described as the benchmark for house price inflation. So when you see clearance rates edging above 60%, it indicates that prices are likely to rise.
That's very interesting.
We are still Yeah, we're still in that realm, right? We've still got a 63%. This is not a booming hot market at the moment, but it is still in the realm that prices are going to rise and a modest increase. And this kind of is in line with what our forecasts are in terms of price growth for next year.
So by definition, that's still a strong market, is what you're saying.
It's a rising market. I think when you've got a really strong market, that's when clearance rates are above kind of 70% and 80%. That is a booming market. So I would say when it's edging between kind of 60 to the high 60s, remember Sydney and Melbourne were at 63%, it shows that we're likely to see modest price growth. November is really that test month. This is where we see high volumes of transactional activity occur because people want to get those deals done before Christmas.
Something that we've definitely seen in recent years, I think we might have touched on this last year, is that sort of buyer fatigue where buyers want to check out from looking at properties every Saturday, which generally starts in December for the Christmas holidays, has been brought forward. The buyer fatigue sort of kicks in now around November, especially with the amount of information we were just talking about that consumers are reacting to. They're like worn out and tired by November. So perhaps, some of that correlates to that fatigue. Can I ask, going back to some of those data points, as a percentage, what type of increases are we seeing in auction or sales volumes in various capital city markets?
I don't have the volumes at the tips of my fingers, unfortunately.
That's all right.
But what I would say is I know that we have seen supply rise and transactional activity is also lifted. And I think one of the other interesting aspects that we've seen in the auction market is there's been a higher levels of sold price as well. So the homes are actually not getting to auction day. The deals are being done before. And I have to comment on the remark that you just made. I really liked how you described that kind of buyer fatigue, because what happens as well in the data is when we come back in the new year, and particularly that late Jan, early Feb, clearance rates bounce. And I think those fatigued buyers that you just described kind of reset and then they come back to market early in the new year with energy to purchase. Yeah. And that happens every single year. So my expectation is we're going to see clearance rates lift early in the new year because seasonally we always tend to see that.
It's so true. They come back sort of re-energized and motivated to make a decision sooner rather than later, especially if they've had 6 to 12 months of missing out, right? They're tired and they want to jump on a decision. Which sometimes takes, it's part of the training, part of the conditioning of purchasing a property is missing out for an extended period of time and realizing that the price guide is generally much below the sold price.
Yeah. Absolutely. And we've seen, going back to that question, I was just finding some data points to answer the other question that you had around kind of volumes. New listings have been a bit mixed across the different capital cities. We have seen, for example, a lift in new listings coming onto Sydney and Melbourne. Sydney was up about 10% year on year. Melbourne was up about 8%. But in some of our markets like Adelaide, new listings have fallen 6%. Compared to this time last year. So it is a bit different. And I think we have to remember that while generally speaking, we do have most capital cities seeing an increase in price, we do have slightly different stages of the property price cycle across our different capital cities. So Adelaide and Perth are far more mature and further along their price cycle than, say, Sydney and Melbourne are.
I find it very impressive that you were able to quickly get that data whilst also talking to me about the previous question. So thanks for doing that. I appreciate it. So let's talk about now, I guess, the year ahead. I guess that calls out all my key highlights I wanted to go through on the key takeaways for the year that was. What about the year ahead? You're already sort of calling out a strong start to the year. I agree. I think we're seeing with all our real estate partners that they go back to work now much earlier in January, and we start seeing listings from the second week of Jan, where some people used to wait till after Australia Day. So strong momentum is probably going to be there in the first quarter. But what about for the rest of the year?
So we have forecast prices for all of our capital cities for the next 12 months. And what we are expecting is price growth across all of them. But the way I would describe it is I do think that 2026 is going to be a bit of a year of two halves. I think we're going to see a stronger first half. And the reason being, I think the 3 rate cuts that were delivered this year are going to continue to provide a little bit of momentum into the housing market in the first half of next year. But also, I think first home buyers are going to be a rising cohort. We've got the expansion of the home guarantee scheme, and we've also got the shared equity scheme that is now in place. That is going to supercharge first home buyer activity.
Yeah, definitely.
And I think particularly in that first half of the year. I think what we'll start to see in the second half, particularly if we see rate rises coming through, I think affordability is going to start to bite. And that will mean that we'll see stronger rates of growth in the first half versus the second half. So the other call out that we've made in our forecasts is we're expecting Sydney and Melbourne to lead price growth. So it's not going to be the cities that we've become used to. So it was, we know that it's been Perth, Adelaide and Brisbane leading price growth. It's going to shift. It's shifting towards Sydney and Melbourne, and that is because these two markets are much more sensitive to changes in the cash rate, and we've still got a bit of momentum in these markets as a result of the 3 rate cuts this year. But our forecasts are not for wild price growth. We've got forecasts of 7% for house prices in Sydney, 6% for house prices in Melbourne, and then a 5% in Brisbane, a 4% in Adelaide, and Canberra and Perth, we've got a 5% forecast for house prices as well.
And would you say it's safe to assume that forecast for, I guess, more growth in Sydney and Melbourne is just in comparison to the year that was, right? If those cities lagged a little bit in growth, especially Melbourne in recent years, naturally they've got to play catch up, right?
Melbourne, definitely so. I think Melbourne, it's still not fully recovered, and Melbourne's been a very interesting market. And our call out is that Melbourne will be fully recovered by the end of next calendar year. And we're expecting record prices across all of our capital cities, even Canberra. So Canberra and Melbourne have both been those cities that have really lagged. That's unusual. Melbourne's one of those cities that normally leads price cycles, but Melbourne's had a lot going on for itself in terms of changes to taxation, steering investors away, and population dynamics haven't been as strong as it once was. These weigh housing dynamics. But Melbourne is expected to be, or Victoria is expected to be the fastest growing state by FY27. So that we know population is a big driver for demand in housing. So this all factors into our outlook and our forecast that we land on. But I think the way I would describe 2026 is I think we're expecting modest price growth.
Yeah, there's a 10-year story to Melbourne and what's happened with that, I guess, property market, especially units, right? We've got a lot of investors that 10 years ago they're about to purchase units, 1-bedders and 2-bedders in Melbourne as investments, and they didn't quite get the growth that they were hoping for in that 10-year period. Some of them still somewhat the same value 10 years later. And I guess that's because in that period, maybe going back, up to 15 years, there was a significant supply in that 10-year window after that. And that supply is now easing a lot, actually, in Melbourne, especially in the unit market. And because of the feasibility is not stacking on the cost of delivering these units compared to what they can sell for. So that reduction in supply should put some upward pressure on prices, right?
Yeah, and this is the dynamic that Melbourne has had much better supply, and that's been the other dynamic that's really weighed on really Melbourne kind of moving into that established recovery. And that established recovery has really only occurred in the last 6 months. It really took some time for it to see momentum building. But I think momentum has definitely returned. I think it's the way I describe it though is patchy. I think it does depend on where you are in the city. Some areas are performing better than others, and I would describe some of those kind of upsized suburbs, those upsized markets that are performing better than other areas. But the fact that we're calling Melbourne to be fully recovered by the end of next calendar year really shows that Melbourne is on the pathway to an established recovery and will be fully recovered, which is a marked difference compared to what we've seen.
All right. And what are some other call-outs? Have you got, we didn't really touch on too much of those favourite keywords, but you think the keywords are going to stay the same through 2026?
Look, I think affordability is still going to be a core threat of 2026. We're expecting some of our capital cities to see unit prices outperform house prices, and that is very unusual. You tend to see houses do see greater rates of growth over time, and that is because it's the land component that appreciates and the asset on it that depreciates. But what we expect is Brisbane units are going to outperform houses. We're also expecting that in Adelaide and in Perth as well. And I think that feeds that affordability discussion we were having. It also aligns to the increase in first-time buyers we're expecting in the market, as well as investors that are a core player at the moment. And I think what we're likely to see is I do think we'll see a bit of a reshuffle in the rankings of keywords. I think, it's words like study. There wasn't that long ago, I suspect we spoke about the word study last year, falling off the ranks, right? It's not as important to home buyers. But I do think that affordability edge, the interchangeable spaces, it really echoes the changing ways in which we want our homes to be configured.
Mm. Yeah, that was probably in the years prior with working from home from COVID, right? Still, there was a desire for bigger housing. So whilst there might not be, I think the push on house prices versus units in that sort of COVID boom period was that more people were spending more time at home and, maybe configuring a bedroom into a study. So that's why we're probably seeing the catch up now in units. So if we sort of explore the main market drivers, we've sort of touched on a couple of them being rates and affordability and how both of them are somewhat plateauing next year. Migration and construction. So we've sort of touched on migration or population growth still being steady the year that was. What about for the year ahead? What are you anticipating that's going to do to prices? And the same as construction. We're still seeing increased costs of construction. Naturally, that's going to make it difficult to get houses out of the ground.
Look, it absolutely does. And I think one of the changes that we've probably seen is we have all levels of government really aligned on delivering supply. And I think, that's a good thing. I think in over the decade more than a decade that I've been analysing our housing market, I don't think I've ever seen every single layer of government so aligned on building supply and affordable supply. I think still more needs to be done. I think the concern is when we have policy levers that really brings forward demand, and that demand being first home buyers helping to prop up price and creates this vacuum effect in demand, and we're not lifting the level of supply at the same rate, which means that it's going to translate into faster rates of price growth, particularly for cheaper properties. But I think overall population growth, we're still expecting robust population growth, but not as high as it once was. I think, we definitely saw a peak after COVID. And I think, what we're seeing is some capital cities are likely to see much slower rates of population growth than they once did. And that changing face of the states that are leading. So we are expecting that Victoria is going to be one of those states that will eventually lead population growth, which historically it has done in the past. And that is because Victoria is much more affordable, particularly when you look at our big capital cities, Sydney and Melbourne. Melbourne really has got the affordability flag flying, and that is because it's a city that can sprawl. It's a city that hasn't seen rapid rates of price growth in recent years, and that affordability edge really makes it attractive for new migrants.
Just going back to the point about construction, you rightly called out, we've definitely seen and heard more noise from government, both state and federal, than the past, right? They're definitely doing making a conscious effort to increase supply. State government here locally in New South Wales is pushing overarching policies for councils so that or imposing overarching policies for councils so that sort of the more mum and dad type developers can get a subdivision out of the ground. Or we saw all those FSR zoning changes near main roads and in sort of public transport and infrastructure. We're seeing Chris Minns actually put some great proposals together. Well, some people might speculate or disagree with the word great for some of them, but at least he's trying. We're seeing multiple sort of proposals in different areas, and all of them are around thereabouts 10,000 homes. So we're seeing progress. And
Yeah.
then I guess from the consumer end, we're seeing new ways of construction come to fruition. Modular housing is the big one. In the past, it was a issue to finance modular construction. There are now banks like Bankwest and CBA that offer solutions to modular construction finance. And for those of you that don't know, that a modular construction is simply a house that's built in a factory. Some of them by robots, and it gets delivered to your land lot on the back of a truck as a finished product, like you're almost ordering a new car to a dealership. It's a crazy era we're seeing. So there has been some progress on that front, that's for sure.
There absolutely has. And look, I'm a particular fan of modular housing. In the UK, you have entire kind of communities built by modular housing. And actually, the standards of modular housing are there, because you've got them being built in a factory environment. So it means the quality control, because you're not battling all types of weather. It is built in a factory and can, as you said, delivered on site within kind of weeks or months versus, the extreme amount of time it takes to build on site. So I think, and there's also increase in build to rent as well. And there's been some taxation changes around build to rent, which I think all of these things and policy changes help. And it illustrates that there's not one quick fix. It needs to be a multitude of levers that governments pull at all levels. And I think, you were speaking there about Sydney, almost the kind of the upzoning that they've done around infrastructure hubs. This is another example of where an area can cope with more dwellings. It is much more cost efficient to provide more homes in locations that can cope with it, rather than urban sprawl. Urban sprawl is very, very costly. You've got to create everything: the roads, the infrastructure, the community facilities that you need, schools, hospitals, everything that goes with it. And we still live in some of the least dense cities in the world. So unfortunately, we do still have a big wave of NIMBYism in Australia, but I think governments are really taking this seriously around identifying the locations that can cope with higher levels of density without changing too much the face of the suburb as well.
So two things on that. Going back to your comment about modular construction, we've witnessed people building 3-4 bedroom homes in like 10, 12 weeks. It's been crazy, and getting it delivered. It provides a solution in regional areas where it's harder to get builders sometimes. So speaking about maybe urban sprawl, or more like that downsizer trend of downsizers, retirees moving to regional areas like the Central Coast or sort of mid-north coast or Hunter Valley. That's a great solution to someone that wants to buy a block and put a house on it. Because then it's much easier to build a house in a certain time frame with a certain budget. And your other point about build to rent, it's crazy how we're seeing in some areas these mixed use developments. Right here in North Sydney, across the road from us on Walker Street, we're seeing a mixed use development that has social housing at the bottom, a hotel, office building, and then the top is all build to rent residential apartments. Those sort of new quirky approvals were just not a thing in the past.
Look, and I think we'll see more and more of those as time goes on. And I think, with the construction sector, it is still strained, and I think particularly in skill shortages. And, one of the other aspects is we might see visa applications being streamlined really for those skills that are in need and in demand. I think that the mixed use precincts, all of this factors into creating a number of different solutions to really help alleviate the supply pressure that we've got in Australia when it comes to housing.
All right. Well, Nicola, that was very insightful as always. I think we're sort of naturally gone through my agenda, just free flowing, and we're perfect segue from one point to another as we always do. Thank you so much for your time today. I know you're a busy person in high demand, and your insights and data at the fingertips is always appreciated and digested well by our listeners. So thanks for your time today.
Thanks for having me on again. It's been great.
All right, the same time next year, all right?
Yeah, and hold me accountable
Yeah,
again.
we will. All right. Thanks, Nicola. Bye for now. And thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcasts. This business is built on word of mouth, so please refer us to all your friends and family. They just want to say tune to the latest property and finance tips. Thanks again. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast. Now let's dive into today's episode.